based on which a new system was unveiled that will allow a taxpayer to update his return within 24 months from the end of the assessment year to correct any errors or omissions in the original filing. However, this provision is not without conditions. To begin with, this option to update an error-filled tax return will not be available if the CBDT has conducted a search under Section 132 or requisition books of accounts or any assets under Section 132A. In addition to this, it will also not help a taxpayer to come out clean if he had been subjected to a survey under Section 132A or received a notice pursuant to seizure of money or any other valuable articles. It appears that if updated return is filed within 1 year from the end of assessment, the taxpayer will have to pay an additional tax of 25%. Whereas, if the new return is filed after 1 year, but before the end of the second year, the additional tax will go up to 50%. I would request Dr. Gupta and Sri Surana to deliberate on this observation and share their suggestions, if any. Apart from this, I would like to add a few of my other observations which may be taken up by the speakers for providing further clarifications. The restrictions of surcharge on long-term gains, LTCG, to 15% for all categories would give a boost to the startups. Earlier, LTCG from assets other than equities would often go up to nearly 40%. The withdrawal of concessional rate of taxation at 15% on dividend income for Indian companies aims to bring parity to the tax treatment when they earn dividends from foreign companies as well as from their Indian companies. The phasing out of concessional customs duty on capital goods and project imports and application of moderate tariff rate of 7.5% will help local players to create a level playing field, as reasonable tariffs are conducive to the growth of domestic industry and Make in India policy. The proposal for replacing the SEZ Act by a new legislation and digitalization of all customs operations in SEZ will improve ease of doing business and enhance competitiveness of our exports. If we speak about the industry sectors, then from a real estate perspective, the budget continues to commit towards affordable housing, increased infrastructure spending on urban transport, highways, and multimodal logistics can modernize and spur investments into logistics. However, incentives to home buyers, especially to the lower and middle income groups, were largely missed in the budget. From the investment point of view, the tax exemptions granted to foreign investors who appoint a fund manager based in IFSC Gift City to manage their global investment should help promote India as a global fund manager jurisdiction. Though, except Gujarat, this model is not applicable in our part. In the automotive sector, with an objective to continue to provide momentum to Make in India, a 1-year extension to the due date for commencing commercial production by new manufacturing unit has been proposed under Section 115BAB. This should provide new manufacturing projects such as those that have opted for the PLI scheme an additional window of time for income tax concessions. In the railways, with a capital outlay of rupees 2.45 lakh crores, the figure is substantially higher than last year's outlay of rupees 2.15 lakh crore, and Railways has announced clear intentions of taking the privatization plunge. Besides proposal for multimodal connectivity between mass urban transport and railway stations with reorientation and standardization as per the Indian conditions and needs would be certainly promote Atmanirbharta. Emphasis on green energy, solar energy in particular, is expected to reduce consumption of coal for production of electricity. The proposal for production of chemicals from coal will therefore benefit the coal mining industry in the eastern region. Before concluding, I would like to reiterate that the government has given requisite attention for increasing digital penetration under Bharat Net through PPP mode and through the introduction of a digital currency. It is quite evident the government is responsive of the needs of the industry and will help us attain a US 5 trillion GDP landmark in near future. With these words, I would request Sri Surana to deliver his address. Mr. Surana.
Very warm good afternoon to all the friends. Sri Rakesh Gupta, Sri Jaiswal ji, Sri Saravgi ji, Sri Choradia ji, members of the chamber, ladies and gentlemen. During the era of pandemic, a number of star speakers, including key economists of the government and experts, including Dr. Pranab Sen, Sri Swaminathan Gurumurthy, Sri Sanjeev Sanyal, addressed the member of our chamber platform. And the prescription was to boost government investment in such a way that the consumption power of the people of the country be encouraged. In our pre-budget expectations, the chamber has suggested various taxation measures in the same direction. However, while presenting the 25-year blueprint, the Honorable Finance Minister stressed on the sunrise opportunities for a modern tomorrow. Artificial intelligence, drones, space, genomics, clean mobility, etc. Surprisingly, the total subsidy bill has been cut by a massive 27%. I agree with our President, Sri Ramesh Saravgi, that budget is bold in its approach, forward-looking and futuristic and inclusive. In an hour of 1 hour and 30 minutes budget speech, the Honorable Finance Minister has promised firstly to repay the outstanding loan of Air India, then secondly, an additional borrowing of 1 lakh crore to the states free of interest. This huge government expenditure would be backed by heavy market borrowings as well as increase in collection of corporate tax, income tax and GST. In the taxation part, therefore, the interesting area in the previous year is that there is no change and stability is being continued, and further substantial relief of surcharge in the case of capital gain has also been given to the higher slave taxpayers, along with further relief that such income shall be excluded for the purpose of calculation of surcharge on other income. This is praiseworthy. While the government has not made any change in the income tax slab, a new subsection, that is section 139(8)(a) of the IT Act, enabling furnishing of one-time updated return.
Because sir, this is school is very close to my heart, and
one-time return, updated return for a particular assessment year can be filed, and a new section 140B for the payment of corresponding additional tax have been proposed in the Finance Bill 2022. However, it may be noted that updated return can be furnished only for declaring income, that is additional income, and it cannot be furnished for claiming any additional claims or refunds. Besides, it cannot be filed in search or survey cases or the cases where the assessing authority has any information in his possession under the Prevention of Money Laundering Act or Black Money Act or Prohibition of Benami Property Act and so on. And such information has been communicated to the taxpayer before furnishing of such updated return. If one wishes to submit revised return, then it has some higher cost, that is additional cost, rupees 25% for 1 year and if it is beyond 1 year, then 50%, along with the tax and penal interest. He has also to pay late fee for filing the return. In the individual cases, tax exemption on COVID-19 and related medical expenditure, as well as financial assistance provided in the case of death caused by COVID-19 has been continued, which was given in the CBDT circular in July 2021. The scope of section 206AB and 206 CCA has been widened, and with proposed amendments in Finance Bill 2022 for the non-filers of the return, this would be a heavy associated cost. In the case of transfer of an immovable property other than agricultural land, TDS is to be deducted at the rate of 1% of such sum paid or credited to resident, or the stamp value of the property, whichever is higher. This was earlier on the consideration mentioned in the deed. Friends, faceless assessment has to be a real pain so far. This year, the old section 144B has been taken away, and a new section 144B has been inserted. By default, right of personal hearing through video conferencing to the assessee, in line with the recent amendments in the faceless appeal scheme. Considering numerous pending cases, the existing subsection 9 of section 144B, mandating that the entire assessment proceedings shall be considered as non-extant law, has been taken out. I don't know whether this will provide adequate safeguard to the revenue, because adoption of the principle of natural justice will always remain, as has been held by the Honorable Supreme Court in the case of AR and Tule. The NDA government promised that they will not make any retrospective amendment, but in this finance bill, a retrospective amendments have been made. That is, section 14A has been amended, and right from the beginning that even if there is no income, exempted income, then even the provisions of section 14A will be applicable. So also section 37 and section 40 has been amended. That is, section 40 deals with the education and other says, which was being allowed as deduction because of the judgment of the Honorable Bombay High Court and Delhi High Court, but it has been amended retrospectively that it will not be allowed as deduction. Sir, we have among our in between us the senior and learned taxation expert, Sri Rakesh Gupta, who is also a poet. I am sure in the special presentation we will get the more insights of the finance bill, particularly the direct taxation front. I have also dispatched my comments and my views on the finance bill to the honorable members. In conclusion, I'll request to state that ease of doing business has been proposed to be launched, but the short-term priorities be considered to restore immediate need of economy and its propel. Thank you. I request Sandeep Tordia to kindly make his observations.
We have Mr. Dr. Rakesh Gupta as well with us. Sandeep ji, would you like to give your observations now or after Dr. Gupta's address?
After Dr. Gupta's address.
Okay. Then I would request Dr. Rakesh Gupta to address and give his observations on direct taxes.
Thank
Dr.
you.
Gupta.
Thank you, Sarawgi Sahab. Respected Shri Surana sir, very eminent persons from the chamber and from my profession. It gives me immense pleasure to be with all of you this evening, to be sharing my views on the Finance Bill 2022. So this Finance Bill was unveiled in the Parliament on 1st of February by Honorable Finance Minister. And though I could not listen her completely because of the ongoing hearings, but then when she started part B, then quickly part B was over. What is this? Kindly, would you please silent because this is a continuous disturbance.
May I request all the guests to kindly mute themselves so that we can have the best use of our honorable speakers, and we can all take the best inputs.
Yes. So she spoke in that brief part B address about the updated return to take care of any omissions or commissions or errors. Then she spoke about the litigation management and briefly hinted about the reduction in surcharge. And with the thanks to the taxpayers, that portion of the finance bill was over. And we thought not much is there. But then thereafter, when this entire finance bill came, then the persons like me and Surana sir, who are neck deep into litigations, they found that it is a feast for the litigating lawyers. Now, as the Surana sir has also spoken about the retrospectivity, I find 4 or 5 features of this finance bill. The first feature which I get, but then this is definitely is a discomfiture. More, it's not feature alone, is about it strikes at the very root of simplification of the taxation laws. I tell you, I mean 2 or 3 proposals now which are there, have done everything to make all those provisions so confusing, so complex that it defies that simplification. Like in case of trusts, the things are being jumbled up. And if you see section 1023C, I mean, the way has gone up to 21st or 22nd proviso. Then even 139(8)(a), as Saraogi Sahab also spoke that this kind of a window or this kind of the concession of filing the updated return is with riders. And there are 13 direct riders, not 1 or 2, but then there are 13 riders, 144B, 148. Now these sections hardly saw the light of the day. And sir modate ole pade wale, I mean that kind of a adage which we have all heard. Again, there are considerable proposals seeking amendment in those sections. Then litigation, as I said, because several places the amendments are proposed in such a manner that which is bound to generate litigation. Though the legislature seeks to have said that these amendments will come from 1st of April 2022 from assessment 22-23, but then the way they have been worded now would leave ample space and scope for the courts to interpret and for the department to argue that the intention of the legislature was always like this. And therefore, even if the legislature has said that it will come into effect from 1st of April 2022, but then they should be read to have the retrospective effect. Then this year's finance bill is not an exception to that kind of a drive of the finance ministry now, which is unleashed almost every year, whereby the decisions given by the courts are nullified. So this year's finance bill is not an exception in the direction. And then regarding the retrospective, of course, I remember Arun Jaitley Sahab in this government, while presenting the first finance bill in this government, then has said that we would refrain from bringing the retrospective. But then retrospectivity has been brought directly, indirectly, or obliquely. I mean, that is writ large. It is littered rather in the entire finance bill. So with this, some features which I have found, now I'll start my deliberations on various clauses of the finance bill. And in that case, the first section which I find is section 14 capital A. Now section 14 capital A, if you remember, was brought by Finance Act 2001 with a retrospective effect from the day when this Income Tax Act 1961 was enacted. And since then, this section has been the subject matter of intense litigation. And one of the facets of the litigation was that if there is no exempt income earned by a taxpayer in a particular year, whether the disallowance of an expenditure can be made under section 14 capital A. As all of us know, section 14 capital A seeks to disallow all those expenditure which have been incurred in relation to the income which is exempt, or we say technically that those incomes which do not form part of the total income. Now, board came out with a circular in 2012 to say that even if there is no exempt income in a particular year, but if there is an expenditure which has been incurred for the purpose of earning an exempt income which may not have fructified, and yet that expenditure is disallowable. Now, despite the intention of the legislature expressed through the board circular, the courts strictly going by the rule of literal constructions found that section 14 capital A does not admit the disallowance of any expenditure if there is no exempt income during the year. And all high courts were almost unanimous. Delhi, Madras, Karnataka, Punjab and Haryana. And I'm not aware about the Calcutta, but then almost all high courts were unanimous. And high courts were unanimous after taking into account the important impact of this contemporaneous expositio as expounded by the board in its circular, and said that the circular may be binding on the tax authorities, but then the circular definitely is not binding on the courts, and therefore the courts confine themselves to the rule of literal construction of section 14A and held that if there is no exempt income, then no disallowance can be made, or the disallowance can be made to the extent of the exempt income. Now, this position of law is sought to be done away with by proposing explanation to section 14 capital A. And as I said a little while ago, that by using those very expressions which are very frightening, and those expressions are that for the removal of doubts, it is hereby clarified. Like these three phrases, wherever the legislature uses, they have got very frightening consequences. And such frightening consequences are to the extent of these provisions being read as if that these provisions were there right from the day one. So it says that for the removal of doubts, it is hereby clarified that the provisions of section 14 capital A seeking to disallow expenditure will be there even if there is no exempt income earned or received or accrued or arisen in the year. And therefore, this first amendment, which I thought that I must share, now has been voted, though it has been made operative by the legislature ostensibly from 1st April 2022 and from assessment year 2022-23. But then, as I said a little while ago, and even at the cost of repetition, I would say that the manner in which this proposed amendment has been worded now is going to be contested fiercely, and therefore the litigations even on this point now it cannot be ruled out. Then we all had witnessed three waves of pandemic, and that pandemic has cost very dearly in terms of the medical treatment expenses incurred by the taxpayers on themselves or on their family members, or in certain cases, and particularly the pandemic or the second wave has witnessed a lot of fatalities. So the government made a press release on 25th June 2021 saying that these medical expenses incurred by an SSE and reimbursed by the employer for the treatment of the employee or his family, now that will be made exempt in the sense that that will not be chargeable to tax by way of perquisite. And in case of the family members receiving any ex gratia amount from the employer or from any other person, now will also not be taxable in case of the employer, the entire amount, or if it is received from any other person, then up to the extent of rupees 10 lakh. So this was the press statement released by the Ministry of Finance on 25th of June 2021. And now Finance Bill 2022 seeks to legislate that declarations made by the Ministry of Finance in its press statement. And therefore, now two sections are proposed to be amended. Section 17 to say that any medical expenses incurred by an employee on his health for the treatment of the COVID-19 or in respect of the health of his family members and paid by the employer now will not be treated as perquisite, but of course subject to certain prescriptions or certain limitations or certain guidelines which will be prescribed by the board. And similarly, in case of the family members receiving the amount from the employer on the death of the employee from the employer, now would not be taxable under section 56. As all of us know, the section 56 says that if an amount is received without consideration, then and this amount received is in excess, this amount received is in excess of 50,000, then this entire amount constitutes income in the hands of the recipient. Therefore, to take care of such kind of a situations, lest it should give rise to the taxability, now amendment is proposed in section 56 by this Finance Bill 2020, that in case the employer pays any lump sum amount on the death of the employee to the family members of that employee, that will be exempt, that will not be taxable under section 56 in the hands of the family members. And if it is paid by any other person who is not the employer, then maximum 10 lakhs of rupees, but then it should be in connection with COVID-19 and it should be paid within 12 months. So certain safeguards have been provided, because no relief comes without ifs and buts. So even the section 17 and 56 to 10 amendments now have also come with those kind of riders. Then comes the amendment to section 37, and this amendment now, which is there under Finance Bill, is really something. Now, as all of us know, the section 37 says that an expenditure which is not personal expenditure and which is not of capital nature and which is not covered by section 30 to 36 of the Income Tax Act, if it has been incurred wholly and exclusively for the purpose of business, is liable. Now then came the explanation, and that explanation was in order to make a declaration, and that too for the removal of doubts that any expenditure which has been incurred for a purpose which is an offense or which is prohibited by law now will not be allowed. Now this explanation 3, which is sought to be inserted by the Finance Bill 2022, now seeks to say that expenditure incurred for a purpose which is an offense or which is prohibited by law. Now what does it mean? And for that they have sought to provide 3 instances. And the first instance, now which not instance, rather the first provision which has been explained in the explanation to be inserted by this Finance Bill 2022 is that even if the expenditure is in connection within even that which for the expenditure is for any purpose which is an offense which is prohibited by law, whether that law is the domestic law or the foreign law. So even if that expenditure has been incurred in respect of something which was prohibited by the foreign law, then that also will not be allowed, because there were certain court decisions which said that this explanation under section 37 then existing now probably sought to disallow only those expenditures which were incurred for the violation of the domestic law, but then its scope is sought to be widened. Now if there is any violation of any foreign law and this expenditure has been incurred for the purpose which is prohibited by that foreign law, then that will also not be allowed. Then compounding fee, I mean, which we used to pay, and of course we pay now and we'll keep on paying. Now there were conflicting decisions I mean, in that score, that compounding fee whether can be said to have been incurred for a purpose which was an offense or prohibited by law. And therefore, one view was this, that this was hit by the explanation to section 37. And therefore, now one explanation or part of the explanation is to this effect, that any compounding fee in respect of an offense under any law, whether the domestic law or foreign law, if you have paid something and you want to claim it, then it will not be allowed. So now, as against the conflicting judicial view, now this is sought to be provided by the finance bill. And the third thing which has come is, in order to nullify all those decisions which had come majorly from the tribunal in respect of the expenditure incurred which were considered opposed to public policy. Like, to be precise, in case of the medical professionals, under Indian Medical Council Act, if medical professionals are provided any kind of benefit or perquisite, then those benefit or perquisites could not be availed, or professionals were restrained not to accept them. But then still, I mean, pharma companies were spending expenditure on the travel, hospitality, and the conference of the medical professionals. So there arose the dispute amongst the various benches of the tribunal as to whether such expenditure incurred by the pharma company can be said to be hit by explanation 1 to section 37. Because the one view taken by the tribunal was this, that this prohibition was for the medical professionals. This prohibition was not on the pharma companies. And therefore, when the prohibition was not for the pharma company which are incurring expenditure, therefore such expenditure cannot be said to be incurred for a purpose which is prohibited by law. But then in a later decision, the tribunal now made out a case to make a reference to Honorable President for constituting the larger bench. And therefore, the Finance Bill 2022 grabbed this opportunity to pick up portions of their decisions and said that now this is a situation which has been sought to be clarified by a subsequent decisions of coordinated strength, though no final verdict has come from the tribunal, because the recommendation was to constitute a larger bench, or to make a reference to the president for constituting larger bench. Therefore, now it seeks to provide that any expenditure to provide any benefit or perquisite to a person, whether carrying on a business or exercising of a profession, if acceptance of such benefit or perquisite is contrary to or is in violation of any law, rules, or guidelines for the time being in force governing the conduct of such person. So now this has been explanation 3 now is sought to be, and that too with that kind of the frightening expressions for the removal of doubts, it is hereby clarified. So again, it will be a potent source of litigations in times to come, whether this clarification which has been done now should be taken to have been clarified or should be taken to have always existed in this form, and the error, I mean, lied at the door of the courts, which interpreted otherwise. So this will be a bone of contention. Then comes again the amendment which is proposed to overcome certain decisions which have been rendered by the tribunal, and not only by the tribunal but by the high courts also. The Bombay High Court in Sesa, Goa, and the Rajasthan High Court in Chambal Fertilizers, and then thereafter followed by, I mean, decisions of various benches of the tribunal, unless your own bench in Calcutta, I mean, came saying that saying that cess is nothing but additional income tax. It is in the nature of income tax, and therefore, I mean, it cannot be allowed as a deduction. Now we have got section 40A small Roman 2, now which says that any tax on the profits will not be allowed as a deduction, because payment of tax is considered as an appropriation. Though payment of tax, I mean, is rather the most essential thing for conducting the business, but then ironically, it is not considered as an allowable expenditure. And there is a specific provision to that effect under section 48(2). But then whether that tax would include within its ambit the amount of cess, that was the question, because there was a board circular in 1967, according to which cess was allowed, or the opinion was expressed by the board, providing for the allowance of the cess. But then the cess was the cess levied by the state government. And those cess were not the cess which were imposed by the Finance Act under the central enactment. And therefore, Bombay High Court and the Rajasthan High Court, unmindful of a very old decision of the Supreme Court in K. Srinivasan, 83 ITR, now rendered this decision that cess, and that too in the face of the circular of the board itself, now is liable to be allowed as a deductible expenditure. Now that allowance of cess by the courts was found not in consonance with the letter and spirit and the intent of the legislation or the legislature, and therefore the amendment is proposed to say that cess imposed by the Finance Act will not be allowed as a deduction. Then section 43B, and now is again, in order to overcome the decision of the Supreme Court, this amendment is proposed. As all of us know, the section 43B now is a provision which says that certain expenditure will be allowed as a deductions against your business profits or the professional income if those amounts have been paid, and will not be allowed to you based upon the mercantile system of accounting which has not been paid, though those expenditures have been laid out. I mean, tax, duty or cess, contributions to the provident fund or the employees' state insurance, the welfare fund of the employees. And there is one, that interest on the loans raised from the banks and the financial institutions. Now, on account of the restructuring, that interest used to be converted into loan, and therefore now on conversion, now the SSEs used to say that since the interest has been converted as a loan, and therefore it should be treated as an effective repayment of that interest. Then came the amendment in section 43B to say that such kind of conversion of interest into loan will not be treated as payment for the purpose of section 43B. But then the legislature used the expressions interest on loan and borrowings. Then came the question before the Supreme Court, now whether interest on debenture, now whether can be said to be covered under section 43B if that interest on debentures has been converted into the debenture itself. So Supreme Court said, since the legislature was a specific interest on loan and borrowing, and therefore interest on debentures, I mean, was to be treated at different level. But this Finance Bill 2022 now seeks to nullify the decision of the Supreme Court to say that even interest on debenture, even if it is converted, now will not be treated as an effective discharge of the liability of interest, or cannot be said that that interest on debentures has been paid, and therefore now 43B, I mean, would hit if it has not actually been paid. Then came a very focal and proposal, that is amendment to section 68. And if you remember, section 68 is a section which creates the rule of evidence, and it seeks to place a negative burden to the effect that if there is any credit in the books of account of a person maintained by him, then its nature and source will have to be explained by that person. And in case the nature and source of that credit is not explained, or is explained but not to the satisfaction of the assessing officer, then it is deemed to be the income of that person. So it creates a rule of evidence, and the negative burden is sought to be placed on the shoulders of the assessee. The law used to be like this right from Estimal. I remember in my early days, 49 ITR 273, we used to argue that the source of the source, cannot be asked to be proved. But then the source of the source to be proved in respect of the share capital or the share premium or similarly placed amounts, was introduced by the Finance Act 2012 with effect of 1/4/2013. That in case of a closely held company, if there is a credit on account of share capital, share premium, then the nature and source will not be treated to be explained unless that person in whose name that credit stands also comes forward and proves the nature and source at his hand. Since the legislature was quite specific to ask you to prove the source of the source in respect to that credit which was in the nature of share capital or share premium alone, therefore the interpretations which were coming from the courts were that this explanation being very, or that proviso being very specific, applicable to share capital and share premium, cannot be extended to loan or borrowings or any other credit. Now, Finance Bill 2022 seeks to insert one proviso again on the lines of share capital to say that, just a minute please, it seeks to say that in respect of any credit in the form of loan, borrowing, or any such amount by whatever name called, loan, borrowing, or any such amount by whatever name called, if explanation offered by an assessee now cannot be said to be satisfactory unless the person in whose name that credit stands also comes forward and explains the nature and source as to the availability of funds at his end. So loan or borrowing or any such amount by whatever name called. Now this is going to generate immense amount of litigations, because okay, I can understand that if I borrow loan or if I borrow funds, then I may request, though it is very difficult for me to make request to a person from whom I am borrowing. Now, okay, now you also be ready to prove the nature and source at your end. It is highly impractical if I expect that my borrower or my lender, would part with such information as to what is the source of funds, because he himself is assessed to tax, that entity is assessed to tax. But then, okay, even if it is assumed that that lender would be willing to part with such kind of information which explains the nature and source at his end, but then, or any such amount by whatever name called, so whole lots of other amounts which may not be in the nature of loan or borrowing, may create problem. Though that is a different matter, that we would say as an arguing counsel that loan, borrowing, or any such amount now will have to be read in such a manner that any such amount must be of such nature which is in the nature of loan or borrowing. But then the way the law is administered in our country, leaves a lot of calls for much scope to be debated. And therefore, if I have received an advance, and then also this proviso expects me that the person who has given me the advance in the ordinary course of my business also be prepared to cough out the nature and source at his end, then I think that will be too much. So this proviso, which is sought to be inserted by the finance bill, now is going to create harakiri. It's already section 68, and particularly in the jurisdiction of Calcutta. I had been reading, in my early days of profession, right from Shankar Industries, that And this entire jurisprudence on section 68 is very dangerously tilted towards the revenue. And therefore, the insertion of this kind of a proviso in section 68 now is going to, create, lots of problems in time to come. Then section 79A, now which is sought to be inserted by this finance bill, that searches do take place, surveys are undertaken, or the requisitions under section 132A happen, declarations are made, and of course declarations are made of the undisclosed income. Now this undisclosed income, against this undisclosed income, even if you have got brought forward losses or any loss, whether brought forward or otherwise, no loss can be allowed to be set off. And so much so, even if you have got brought forward depreciation or unabsorbed depreciation, even that will not be allowed to be set off. So what is expected, that whatever income is disclosed at the time of search or survey, then you must be prepared to cough out the tax which is applicable. And you are not entitled to claim the set off, the legitimate set off. And I don't know, I had been witnessing this trend, since last several years. Like I have seen 115 BBE, that if there are income which is chargeable to tax under section 68, 69, then no set off whatsoever will be allowed. Now I can understand with respect to those income whose sources is not ascertained, but here they are talking of the undisclosed income which may be of a definite source, and yet you say, yet you want to provide that no set off against such income will be allowed, is something which again would operate very hard. And then the definition of undisclosed income. Now this definition of undisclosed income, which is sought to be appended under section 79A by this finance bill 2022, now is on similar lines which is there under section 271 AAB. And even there also I could not understand, and here also I cannot understand, because when I and Raj, my partner, wrote our book on search and seizure, we have said that in my 38 years, if Surana Saab is senior to me, probably he may tell under what circumstances, which are those circumstances when an income is required to be disclosed to the principal chief commissioner or chief commissioner or principal commissioner or commissioner before the date of search or requisition or survey. Now I have not been able to find answer to this question, because undisclosed income means such income which has not been disclosed, such income which is represented either wholly or partly by any money, bullion, jewelry, other valuable article or thing, and which has not been recorded on or before the date of search or survey in the books of accounts regularly maintained, or which has not been disclosed to the principal chief commissioner or commissioner. I do not know. It was there under explanation 5 to section 271(1)(c) also. Maybe I may have missed some portion of the Income Tax Act, but then I could not lay hands. So this undisclosed income has been worded in a very comprehensive manner, and if undisclosed income declared the time of search or survey now is of this nature, then one is required to pay tax without claiming even the legitimate set of the loss, whether brought forward or otherwise, or including the unabsorbed depreciation. Then section 115 BAB, as all of us know, that concessional tax regime in case of the new companies incorporated. If such newly incorporated companies commence the manufacturing or productions on or before 31st March 2023, and this concessional tax regime is applicable in those companies who are willing to forego certain prescribed incentives and the deductions. So one of the conditions, as I just mentioned, was that they must commence the manufacturing or the production facilities on or before 31st March 2023. Now since pandemic is stalled, several things, and therefore the government, showing its sensitivity, now has proposed to extend this time from 31st March 2023 to 31st March 2024. Similarly, in case of the startups, this time limit is sought to be extended by 1 year. That in case that startup complying those conditions are entitled to claim 100% deductions in respect of 3 years consecutively out of 10 years block from the incorporation. Now, were required to be set up by 31st March 2022. Now, one year further time has been given for the startups to come up under Section 80 IC. Then, virtual digital asset. Virtual digital asset now has been the talk of the town and has covered a reasonably good space in the print media. Cryptocurrencies, I mean, which is very popularly known as cryptocurrencies. So virtual digital currency gain on its transfer is sought to be taxed at the rate of 30%. That is what Section 115 BBH has come. And not only it seeks to provide 30% state tax, but simultaneously it seeks to provide that no set off of any loss. Of course, cost of acquisitions, I mean, fortunately, I mean, they have said that that will be allowed as a deduction. But then apart from the cost of acquisition, now it says no deduction in respect of any expenditure, alliance or set off of any loss shall be allowed to the SSC under any provisions of this act in computing this income. So nothing will be allowed, and no set off of loss from the transfer of virtual digital currency. Suppose if there is a loss, then this loss will not be allowed to be carried forward. It will not be allowed to be set off. But then one thing which I was wondering, because we have got several types of digital currencies, virtual digital currency. So whether the loss in one virtual digital currency is available to be set off against the income arising on the other types of virtual digital currency, now that is also not clear. And but then there should not be any reason that why the income or loss, I mean, should not be set off under the same class of assets on its transfer, or income or loss which is arising on its transfer. But then the way subsection 2 of section 115 BBH has been worded, and the way this profit on the digital or virtual digital currency, and I seen with somewhat contempt, there may well be the possibility that even this loss inter se incurred or earned on the transfer of different types of virtual digital currency, I mean, may not be allowed, though that may be an issue. And apart from this, the 194S now seeks to provide that a person who is making payment in respect of the virtual digital currency now is required to withhold or deduct tax at the rate of whatever percentage is there, at even 1% is there, so that the government may track. So 194S is also there. One very important amendment now which has gone unnoticed is the change in the definition of income tax authorities in case of survey. If you remember that under TOLA, Taxation and Other Laws, Amendment and Relaxation of Provisions Act 2020, with much fanfare, it was declared that income tax authorities for the purpose of conducting survey will be those authorities who work or who are subordinate to Principal Director General Investigation or Director General Investigation or Principal Chief Commissioner TDS or Chief Commissioner TDS. Thereby, this was the interpretations that now only investigation department or the TDS wing of the tax department would be competent to conduct survey. But then before this changed definition of the income tax authority, I mean, could be understood by all of us. Now this Finance Bill 2022 now seeks to put that definition again on the back burner, in the sense that it seeks to provide now that all these authorities who are subordinate to Principal Director General and the Director General, investigation word has gone. Similarly, who are subordinate to Principal Chief Commissioner TDS, that has gone. So all those authorities which are mentioned under that explanation to section 133A, who are subordinate to these authorities, now would be competent to act as income tax authority for the purpose of conducting survey. But only one rider has been given, that as specified by the board. So if the board doesn't specify, then all authorities, who were the authorities hitherto prior to TOLA, now would be competent to conduct a survey. And therefore, now this amendment in section 133A, which seems to have been inserted very innocuously, very innocently, in a very silent manner, now has got certain ramifications and implications. Then comes the updation. Then comes the updation, and that updation which was referred by Honorable Finance Minister in her budget speech also, section 139(8)A. And really that makes a very interesting reading. And what has been the purpose? I mean, what has been because it is not very long ago the Settlement Commission was settled by the Finance Act 2021. And again, such kind of provision has been brought, but with so many ifs and buts, and with a cost, and cost is also, I mean, somewhat hefty cost. So let us see as to what is section 139, subsection 8, capital A. It says that any person, whether he has furnished his return in time or belatedly, or who has filed revised return or not. So any person, whether he has filed a return or not, now is entitled to furnish an updated return of his income. But then such a return would set forth such particulars as may be prescribed within 24 months from the end of the relevant assessment year. So this updation or updated return can be filed by any person, whether he has filed his return for this assessment year earlier or not. And the time limit is that he can file the updated return for 24 months from the end of the relevant assessment year. So in my this deliberations at the beginning, I made a reference that Honorable Finance Minister in her budget speech made some reference of some omissions or errors, but then I could not find, I mean, from the fine print as to whether there are any particular errors or omissions alone, I mean, which can be updated in this updated return. So I could not find. So meaning thereby that an SSE or a person is entitled to file updated returns irrespective of anything. And probably that may be for the reason that because of the advent of too much informations now coming into the kitty of the government, like Form AIS now which has come, so that will keep on updating, and therefore the informations will pour into the SSE also. Oh, this was the information, I mean, which would lead to the escapement of income. And in case I have not paid tax, I must pay tax now along with the cost of finance. That additional tax I must pay. That may be the reason. But then what has been because in memorandum also I could not find the rationale or justification for bringing, I mean, such out of the box provision of the updation of it, because we have heard so far the original return, we have heard about the loss return, we have heard about the belated return, revised return, but one more, yes, we had read about the defective return also. So even this updated return can also become updated return, the tax is not paid and the proof of tax is not, I mean, is not accompanied with the updated return. So now one more type of return has come on this income tax horizon, that is called the updated return. But then, as I said in my beginning, that there are as many as direct 13 or should I say prohibitions or the denials or the restrictions. So the first is that this provision of updated return, I mean, will not be available if the updated return, if somebody wants to file a return of loss, then it will not be allowed. Or your updated return has the effect of decreasing the total tax liability which is already determined on the basis of return filed by you earlier. So if this updated return now has the effect of decreasing the tax liability as compared to the liability shown by you in your original return, then also this updated return is not possible. And the third denial is that in case this updated return results in the refund or increases the refund on the basis of the return furnished by you already under section 139, 1, 4 and 5, then also, one is debarred. And of course, if this kind of a concession is sought to be doled out in the form of the updated returns, then of course, one cannot be permitted to file a loss return or a return which decreases the liability, tax liability, or which increases the refund. So the first three riders now which come in the way or which obstructs the path of updation of return is this. The second set of disabilities. The first three kind of disabilities were with reference to the return. Now, next four types of disabilities are in respect of the events. That updation of the return will not be allowed to a person if search has been initiated under section 132 or a requisition under section 132A has been made. So if search has been initiated or requisition has been made on 132A, then such person shall not be eligible to file updated return. Second, if survey has been conducted, survey of course, not the survey, not the TDS survey or the TCS survey, but then even if there is a survey which is conducted in connection with any ceremony or function or occasion, even that is also, if that has also been conducted, then such person in whose case a survey has been conducted now will not be in a position to file the updated return in case he wants to file. The third category of persons is that where the notice has been issued to such person that any money, bullion, jewelry, valuable article or thing which has been found in case of some search belongs to him, and notice has been issued. Now, which notice has been issued now has not been made. So this will be because what kind of a notice is issued? Like under section 153C, now there used to be a notice. Now, as all of us know that for such kind of persons, now their assessments will also be made under section 148. The notice under section 148 will be issued. So whether this notice has been issued to that effect means the notice under section 148 has been issued to such person, it's not known. And even if that notice under section 148 in case of such kind of a person has been issued, now how would that person come to know that this notice under section 148 is in respect of any money, bullion, jewelry, valuable article or thing belonging to him has been found somewhere else? So this notice has been issued now is not clear from the scheme of section 139(8)(a). And fourth kind of person is that when the notice is issued to a person that not money, bullion, jewelry, valuable article or things belonging to him, but books of accounts or the documents relating to him or any informations contained therein pertaining to him have been found in somebody else's search, then also such person is debarred from filing updated return. So this notice has been issued to this effect. What would it mean? Now that is something. So such persons would not be able to file updated return for the year of search or the year of survey and 2 assessment years preceding. For the assessment year relevant to the previous year in which the search is initiated or survey is conducted, and 2 assessment years preceding such assessment year. So these 4 kinds of persons will not be entitled to file updated return for the year of search and survey and the 2 years preceding to this assessment year. Then next sets of 6 kind of persons who are deprived of from this benefit of filing updated return now is where this person has already filed updated return for this assessment year. So this updation benefit is available only once, it's not repetitive. So if he has already filed updated return, then he cannot file another updated return for that very year. Second is when the proceeding of assessment or reassessment or recomputation or revision. Sections have not been mentioned. So assessment or reassessment. Now, what does it mean? The referring 147 on 148 or even 143.3 is also being referred. I mean, it's not known. Yes, of course. I mean, in 147, both words have been used, assessment or reassessment. But then it would have been better if the section would have been mentioned here. So if any proceeding for assessment or reassessment or recomputation or revision is pending or has been completed for the relevant assessment year in his case, then also such person for that assessment year will not be entitled to file updated return. The next category of persons is where the assessing officer has information about this person. Under SAFEMA, under Prohibition of Benami Property Act, under PMLA, under black money, and the same has been communicated to him prior to the date of furnishing a return under the subsection. Now again, it's very vague. Now, communicated to him. Now, whether communication, even a letter letter will be considered, letter simpliciter will be considered as communication, or if there is some notice under these acts which are issued can only be taken to be communication. Now that is a question. Now, then if the information for the relevant assessment year has been received under an agreement entered into by the government of India under section 90 or 90A, I mean with other countries or the specified territories, then and such information has been communicated to him prior to the date of furnishing of such return. So even such kind of persons, I mean, will be debarred. The next category of persons is where the prosecution have been initiated for the relevant assessment year in respect of such person prior to the date of furnishing of return under this subsection. Now again, it's very vague because now in prosecution may be in respect of the technical breaches also. Prosecution may be, I mean, prosecution may be making a wrong statement during the course of search or under section 131. So whether or for that matter for the non-deposit of TDS after deduction. Now, because the way this clause has been worded that prosecution proceeds under chapter 22, that encompasses all sorts of prosecution. So any prosecution which has got nothing to do with the income of that person for that relevant assessment year, now whether would also be debarred under this clause from filing updated return. And last but not the least is that those persons who may be specified by the board or the category of persons which may be specified by the board. So these barring 13 situations which have been specifically spelled out, an unspecified number of situations which the board has kept close to its heart for future reference and prescriptions. Now 139(8)(a) updation of return can be filed by a person within 24 months from the end of the assessment year. But then this updation of return has to accompany with the proof of payment of tax, interest, whatever is there. We will come to that little later. But then section 140B now is a new insertion proposed by the Finance Bill 2021. Now, according to which, if a person has filed his return earlier, or if a person has not filed his return and he wants to file only updated return, then whatever tax and interest would come, and he is very fortunate that the credit which is contemplated to be given to him now is that whatever advance tax he has paid, he will be given credit. Otherwise, when such kind of concessions are given, then what is taken from the other hand, now that itself is $1 million question. But fortunately, whatever tax liability or interest liability will come in respect of that updated return, the credit of amount of tax already paid as advance tax will be given. Tax deducted or collected at source, that will be available. Relief under section 89 which is admissible to him, that will also be available. Any relief of tax or deduction of tax at source in any other country in respect of the income under section 90 or 91, or under section 90 capital A in respect to the income earned in the specified territory, or any tax credit which is available under 115 JAA, the MAT credit, or 115 JD, the AMT credit. So these many credits would of course be available as against the tax and interest liability. But then he will have to pay interest under section 234A also, because he has not filed his return. So he will have to compute interest under section 234A with reference to the assessed tax. The tax computed on the basis of the income declared in the updated return and reduced by these amounts, that will be assessed tax. And with reference to the assessed tax, the 234A interest, 234B interest, and 234C interest. I mean, since he has not paid the advance tax, now that is required to be. And but then where he has furnished his return under section 139(1) or belated in 139(4) or revised in 139(5), then whatever tax, I mean, would come in that updated return, against that the tax which has already been paid by him along with his original return, the credit of which, I mean, that will be given. Tax deducted or collected at source in respect of such income which is now being offered, now that will be allowed. Any relief of tax under section 90, 90 and 91 in respect of the income which is now being offered in the updated return, that will be allowed. And tax credit under section 115 JAA and JD, and MAT credit or AMT credit which has not been taken in original return, now that can be allowed. And in case if any refund has been issued with reference to that original return, that the amount payable will be increased by the amount of refund as already issued. And then this person, since having filed the return earlier, now will not be required to pay tax under will not be required to pay interest under section 234A, but interest under section 234B and section 234C now is required to pay. Now then comes as to what is the amount of cost which he has to pay by availing this benefit of extended period of filing updated return, and that has been given under subsection 3 of section 140B. It says that 25% of the tax and interest, you aggregate the tax and interest payable as a result of you filing updated return, pay 25% thereof if you are filing the updated return within 12 months, but of course beyond the time of 139(4) and 139(5), that is 3 months prior to the end of the assessment year. So beyond this, if you are filing your updated return, but then before expiry of 12 months from the end of the assessment year, then 25% of the tax and interest. And if you are filing after 1 year from the end of the assessment year, but before the close of 24 months from the end of the assessment year, then 50%. And kindly see tax and interest. So if interest is from a definite source, then of course the tax rate of 30%. But then if there is income which is being offered is from the undisclosed source, then the tax rate which will be applicable will be tax rate of 115 BBE. And that 50% or 25% additional tax now will be with reference to that kind of a tax. So that has to be borne in mind. So 139(8), but then I was wondering that under the black money law, if an income from a source located outside India is not declared in the return filed under section 139(1) or 139(4) or 139(5), then that is treated as undisclosed foreign income. So if there is undisclosed foreign income which is sought to be declared by a resident individual or a resident SSE in this updated return, then also that will continue to be haunted by the black money. So unless there is some corresponding amendment which is brought under the Black Money Act, so an SSE cannot claim, since he has paid taxes in respect of his foreign income in the updated return in the section 139(8)(a), but unless there is an amendment in Black Money Act, that income, would continue to be treated as undisclosed foreign income. 144B, as Surana sir has also spoken about that TOLA brought Taxation and Other Laws Amendment and Relaxations Act 2020 brought section 144B with effect of 1/4/2021. But then this section, became a hotbed for immense amount of litigations. And I tell you that in my 38 years of active professional practice years, I have not seen so many good numbers of the assessment orders which were challenged directly before the High Court. And much credit for such insurmountable number of litigations was subsection 9 of section 144B. But as Surana sir has also said that even if subsection 9 now you have removed, or you are proposing to remove from section 144B, yet absence of natural justice and passing the assessment order, the assessment order can still be challenged by way of it. But anyway, subsection 9, the broad contours of section 144B now has remained the same, except that personal hearing through video conferencing now has been inserted under the new section 144B. But subsection 9 of 144B subsection 9, which used to say that if any of these mandatory conditionalities of section 144B if are not complied with, then the assessment order will be non-est. Now that subsection 9 itself is now sought to be consigned to the dustbin of history. Then comes 148, the 148A, 148B, and 149. Now this section 144B, was also of very recent origin, and similarly section 148, 148A, etc. Were also brought by the Finance Act 2021 as a measure of complete revamp to the whole system of reassessment. But then by the Finance Bill 2022, very interesting amendments are proposed in this juvenile section 148. First of all, section 148 provides. Okay, Avikji, I will be precise. I can leave it because I can say that there are lots of amendments which are made in 148, 148A, and it is sought to be rewritten. And similarly 194IA, that in case of the transfer of immovable property, the transferee now will have to deduct 1% with reference to the stamp duty value, not with reference to the actual amount, unless that actual amount is larger than the stamp duty value. Then 239A now is sought to be inserted by the Finance Act to say that where under any arrangement or agreement if a person is required to pay tax, but then he disputes that he is not required to pay tax in respect to the foreign remittances, then he can make an application to the assessing officer, and section 239A is for that. Then there are amendments which are proposed in various section penalty provisions, 271 AAB, AAC, AAD. Then AAE in respect benefit is extended to the specified persons in case of charitable trust. Section 263 now amendment is there, empowering the chief commissioner or the commissioners or the transfer pricing jurisdiction to revise transfer pricing order. And then in case of trusts, several rationalizations have been done. So friends, thank you from the core of my heart. And now Surana Saab or any other dignitaries may take it over. Thank you from the core of my heart.
Thank you, Gupta साहब. आपने बहुत अच्छा, बहुत simple language में बहुत अच्छी से समझाया. Everybody will appreciate the way in which you have made the law understood. Really, it was very difficult for general people to read out so many complications. As you rightly said, this will arise a number of complications. So thank you very much on behalf of the chamber, Gupta sahab. Now I will invite Sri Jaiswal to deliberate on the indirect cases.
Yeah, thank you, Dr. Gupta. Thank you to all the eminent members of the chamber. I'll actually fast pace my presentation, keeping in mind that I have 15-20 minutes. So while there is a presentation which I wanted to run through, but just in the interest of time, what I'll do, I'll basically talk about the important points which are there as a part of the changes which has come under the customs and IDT standpoint. So while when we actually heard the budget speech of Madam, there was nothing specific which was announced on either on the GST side. Some changes were made or announced on the customs front. But when we actually saw the fine print, what we found that there are changes which are noteworthy, which are there under both GST and customs statute, so to say. If we talk about the customs, so first, the major change which is there and which is more from a statute standpoint, that there was a dispute which was going on and which was with respect to the power which a DRI officer has with respect to issuance of any Surcharge notice or not. There is a recent decision of Supreme Court in Thailand, India, which came in March 2021, wherein Supreme Court held that the DRI officer does not have a power. He is not a proper officer under the customs statute to raise a notice under section 28. And primarily the rationale as to how they arrived at that decision were that one was basically on the fundamental point that if one reads section 28, it refers to the term the proper officer. And so on that point, what they actually observed that the term which is a prefix before the proper officer is the, which is a definite article and not an indefinite. So it has to be a particular officer who has actually issued a notice, who has earlier done the appraisal. So if a bill of entry has been appraised by a particular officer, then the notice has to be raised by that particular officer of that rank. It cannot be any other person from any other department. While there was a notification which was issued by the CBEC, which was under section 2 subsection 34 of the customs statute, the Supreme Court also held that if there is a power, then the power is only with the central government, which is under section 6 of the customs statute, and also the definition of proper officer, which is there under section 3, does not include a DRI or any investigative officer. Basis this a rationale, which are the 3-4 points, they actually held that the DRI does not have any power to issue a Surcharge notice under section 28. And because of what happened, that the matters which were pending before Tribunal and High Court, they were then decided on the basis of the decision of the Supreme Court, and the notices which were raised by the DRI in all those proceedings were held to be infructuous or invalid. Now, because of the amendment which has happened or which is there in the finance bill, they have amended 3 provisions, 2 subsection 34, which define the term proper officer, to say that proper officer will include a person or an officer which is authorized under section 5 of the customs statute. Under section 5, they have empowered the board or the principal chief commissioner or the principal commissioner to delegate the power to or notify a person who can carry out this rights and functions which are assigned to them. And under section 3, they have also amended the definition of a proper officer to include a DRI or any investigative officer. Because of, by virtue of this, all this amendment, the attempt which has been done, they have tried to nullify the observations of the Supreme Court in Thailand, India. They have also brought a provision in the finance bill to basically retrospectively validate what has happened in the past. So any proceeding, any notices which are issued or any proceedings which are open as of today, those will be held and deemed to be read in virtue of the provision which has been made or proposed to be made in the finance bill. And therefore, all those proceedings will be held to be valid. This is one. They have also inserted a section which is section 110AA under the customs statute, wherein they have empowered that a DRI officer can do an investigation inquiry, and basis their observation, they can transfer the matter to a person under section 28AA, who then thereafter raise a notice. So this is one change which is important, which has happened, which will impact the past period. and is now also the officer, DRA officers are authorized to issue a notice. This is one which was important. The another change which has happened is in context of basically advanced ruling provision under section 28IJ. Yeah, what has happened that there was a WCO report of 2018, and possibly this amendment which has happened may be a trigger or a pursuant to this. The WCO has given a report in 2018 saying, and which was after a Basel Ministerial Committee, that for classification, for determination of origin, or for determination of duty rate, any of these three, including valuation, there has to be an advanced ruling which is valid for a certain period of time. And what they recommended that this time period can be for a period of at least 1 year, and it is for the respective country to decide. But for determination of origin, which is under the FTA agreement, the period ideally should be for a period of 3 years, for which this advanced ruling should be valid, and which may undergo a change if there is a change in fact or if there is a change in law. And what seems that in this finance bill, they have sought to amend this provision to put a timeline for the advanced ruling. Now, what will happen due to this, that the advanced rulings which are taken will not be valid for sort of eternity. It will be valid for a time period. And therefore, there would be a need that if the period expires, one has to again apply for that advanced ruling. This is the second change, which is the important one, which has happened from a provision standpoint. The third change which is there, which is more of a clarification, which is come in, which is for the social welfare surcharge, which is there. There was a sort of a debate or the some confusion which was there at a ground level, at a departmental level, that for items which are exempt from payment of customs duty, basic customs duty, how the social welfare surcharge will get levied, while the officers were taking the stand on the ground that it has to be computed on the notional value. From an assessee standpoint, the interpretation was that if there is no customs duty and surcharge is actually a levy on duty and is not on the value of the imported item, the question of duty payment should not arise. And this is something which was already dealt in a similar context in a case of Northeast or area-based exemption notification under central excise. And there are multiple Supreme Court decisions in case of Bajaj Auto, SRD Nutrients, and even High Court decision in case of Rajasthan and other High Court, wherein they have held this principle earlier in context of education cess, thereafter in context of NCCD. If you do not have a levy of duty, then any education cess or NCCD, which is a surcharge thereon, should not get attracted. It seems that in the circular, while they have not mentioned about those decisions, but they have clarified that this should not be applicable. Now, by virtue of this, this position will possibly get settled now, and the issue should not come up. The fourth change, which is there, and which is an important one under the customs statute, which has happened, there is a concept of a project import scheme, which is a concession rate of duty, and which is consistent irrespective of the classification of material, which varies from 0, 2.5%, and 5%, the basic custom duty. So instead of the median rate, which is applicable of a 7.5%, if someone is actually undertaking the substantial expansion or setting up a new factory, they can actually approach their respective ministry and go for this scheme. And under this, they should have actually imported capital goods at a lower or at a concessional rate of duty. What has been mentioned by Finance Minister in her speech, that there is a National Capital Policy 2016, where the intent is to actually encourage domestic players who are manufacturing capital goods. Now, in order to provide a fillip and in order to boost this industry, the concessional duty benefit which is available on import, they are phasing out. So therefore, this scheme which is right now there will get phased out over a period of time. What they have provided as a part of sunset clause, that this will be valid if any company, either a substantial expansion or a new unit, goes for an approval and gets an approval by 30th of September, and they can import under this scheme at a concessional rate only up to September 2023. After this concessional rate of duty benefit will go away. Now, while they have not spoken about, but what is also interesting, that there is also a scheme which is a manufacture and other operation in a bonded warehouse regulation, which was introduced in October 2019. And as a part of under this scheme, is still if a company or a firm can actually import, if they require something for the purpose of manufacturing without payment of duty, the taxable event is deferred in such cases. It is not exempted, but there is a sort of a long-term benefit which should be available. Now one has to see that if this step which has been taken to actually phase out project import, if the intent is to provide that stimulus to the basically the local capital that's manufacturer, what they will do for this scheme, which would be interesting to see. As of now, there is nothing which is mentioned over there, but we have to see if there is any change which is likely to happen over here. The fifth point, which is important and under the customs statute, is the duty rate changes which has happened. Basically, what they have done, one is more of a structural change. What we actually, what we were seeing that because of the exemption notification, which is the 50/2017, a lot of items are eligible for unconditional exemption, and because of which what was happening that the effective rate of duty which is there is by virtue of that notification should have been mentioned in the tariff itself. Now the government is making an attempt to basically align the tariff rate with the effective rate of duty, especially where there is an unconditional exemption. So this is basically the fifth change which is there. And besides this, there are a lot of changes which has happened on the duty rate, which I'll skip because basically it is mentioned in the schedule. So these are the important changes which are there from a customs standpoint. Moving to GST. From a GST standpoint, what has happened that if we have to see this budget, broadly we can split this into two broad categories from a GST standpoint. The changes which has happened from an input tax credit standpoint, and the changes other than input tax credit. So we'll first talk about the input tax credit changes which are there. The theme which has been there in this budget is something which has been similar to the previous year. What we are seeing from basically the action or the amendment which are happening, somewhere the mindset is that you made the recipient who is going to avail the input tax credit more responsible. The onus has to be shifted on so that whatever claim which are taken for the input tax credit, if there is any vendor non-compliance, then it has to be addressed even, and the recipient also has to be jointly responsible for this. When they started with GST in 2017, they came up with a concept of a return where there were 3 returns, 1, 2, and 3. And they were also talking about a portal, which is an online portal where everything will happen at a transactional level. Over a period of time, what happened that somehow this did not got implemented. And for this, the relevant provision were section 42, section 43. When it was felt that there could not be 3 return, how they actually placed this, they mentioned about that instead of 3 return, you'll have only 1 return. And there are 3 unassures. One is unassure 1, which is outward return, unassure 2, which is for the inward, and then you have a 3B summary return. And for this, what they thought about that they will bring in a provision, which is section 43A. Now, because of this, over a period of time, we had section 42, 43, and 43A, which, however, because the electronic platform was not able to provide the matching at a transactional level, this provision sort of was no longer required. And what we saw that in this budget, the government seems to have basically the objective of putting a validation on the input tax credit chair. They have sort of put it entirely on the customer, and the plan of bringing in the portal for the matching and enable in terms of the provision 42, 43, 43A, this has been proposed to be omitted. And because this 42, 43, and 43 are going out, and the earlier concept of unassure 1, 2 or GSTR 2, which would no longer be there, they have also made a lot of consequential change in section 37, section 39, and obviously which they have totally replaced. And I'll come to section 38 in a while. But what they have done by doing this, they are basically amending the provision to shift the entire responsibility on the recipient and how they want to do this. So what they are talking about, that section 38, and possibly most of you would have heard about that the vendor data which gets filed, that's reflected in the GSTN portal in GSTR 2A, which is at a transactional level and which is at a dynamic level. If the vendor actually uploads the return subsequently, the 2A will change for that period. They thereafter came up with a different static return, which is GSTR 2B, which they brought in by bringing in Rule 60, Sub Rule 7 under the CGST law in the previous year. Now, while this was there, what was missing actually are enabling provision in the statute, which they in a way actually did in the last year, which became effective from 1st January 2022. They brought in under section 16 subsection 2 clause AA, wherein they mentioned that whatever transactions of outward supply which has been uploaded by the vendor has to be communicated to the recipient under section 37, which means that if the communication has not happened and a recipient is supposed to actually see if the vendor has uploaded, then only you claim that input tax credit. This is one which is already sort of enacted and became effective from 1st January 22. The second bit, something which is similar, which they are talking about in this finance bill, which is a new sub-clause, clause BA, again under section 16.2, they are saying that your credits should be limited and in the manner which is prescribed under section 38 and which will be subject to conditions and restrictions which are put under section 38. And therefore now section 38 becomes very important because we have a provision section 16.2BA. It has to be communicated. Our recipient has to monitor whether the vendor has uploaded the data or not at a transaction level. There is also a condition that the vendor should have also discharged the tax liability beside uploading that data. The upload of data happens in a transactional level return, which is GSTR 1. The payment of taxes happens in GSTR 3B, which is at a summary level. Both are sort of, one is at a summary and one is at a transactional level. While at a total value, one can match the amount, but at an invoice level, it is very difficult even for the government to identify that for which invoice, while it has been uploaded in GSTR 1, whether tax has been paid or not, which is next to impossible because 3B is at a summary level. So what they are talking about now as a change, and now which possibly one will be able to follow, there are 4-5 conditions which they have put it under section 38. Condition number 1, that it's the tax which has been paid, the 1 and 3B, there should not be difference in the vendor return. Now it would be difficult for the government to figure out that what is the difference between 1 and 3B. Now how basically the challenge is how a recipient will keep an oversight that what is going in 1 and 3B at a transaction level, because that data, the recipient is not a privy to that data. This is one. First, I'll just explain the challenges and then possibly I'll also spend a minute as to how the other companies are approaching this so that it may be helpful for most of the people. So this is one. The second, which are the newer conditions which they have put in. Now the vendor is also supposed to claim credit in terms of section 16.2. If the vendor has claimed more credit, what is eligible to him in terms of form 2B, then to that extent, there is an obligation on the recipient also to restrict his credit. Now, if one takes an example, let's say if my vendor is eligible in terms of GSTR 2B credit of 10 lakh rupees, but he has taken 15 lakh. Now, for his compliance at the vendor level, if he is not able to comply, then they are talking about there would be some restriction which would be put in at the end of vendor's recipient, which should be basically the person who is buying from that vendor, which is the second restriction. Third, they are talking about that there is a provision under Rule 89.4 that you can't utilize your entire basically credit for making tax payment, barring certain exception. You have to pay at least 1% output tax in cash without utilizing the input tax credit. This is also put as a condition as a check. Now, likewise, there are 4-5 conditions which has been put in, and some are residuary in nature, which they will come up by way of a notification. But what becomes important, that how a vendor is now going, a recipient who wants to claim this credit has to comply with this, because he would have some vendor who is basically a large vendor who are going to basically file GSTR1, e-invoice is applicable to them. It would be easier for those set of vendor. There would be certain set of vendor who are totally return filer, who does not file return on every month, and obviously e-invoicing may not be applicable to them. So how I am going to see their 2B on a monthly basis? Third, there will be some dealer who may not be organized and may not be filing. So there may be timing difference. There may be some unorganized vendor. While this is a provision which they are trying to brought in, and without going into the legality part of this, which will be subjected to challenge, which we have seen in the past, in the VAT regime, there are favorable High Court and Supreme Court decision. But the challenge that there is a panic which may get created, because department is going to basically rely upon analytics. And if they actually say that there is a difference, how the assessee is going to reconcile, which means that they have to reach out to each and every vendor before providing a response to the department. Once they provide the response, then only some resolution will happen. So this is a very, basically when I'm trying to explain, it may sound very difficult, but what is important as to how the department is going to implement this and what will happen on the ground. So there may be a lot of notices which may arise from this, but at the same time, what companies can do and what they are thinking about, at least a vendor compliance rating. This is something which is possible. Second, what is possible, that whether those vendors are filing 3B or not, this data is available in the GSTN portal. So this could be fetched, something can be automated, and there is a need for automation right now if someone has to respond to all these queries. Otherwise, it may become very difficult in addressing all this thing manually. Legally, obviously, there is a resource people would be going to it, but this has to be seen how this will pan out. So this is largely on the ITC sort of matching provision, which is sought to be built in. The second, which is a very good change which they have done in, basically they have extended the time limit for availing credit. Earlier, which was basically September return, which was becoming due on 20th of October. Now they have amended the provision to provide the time limit for availing credit would be 30th November. The only doubt which is coming as of now, they have mentioned 30th November. So whether, while there is an extension obvious, but will it be November return which will get filed on 20th December, or it is the credit has to be availed before November? The basically ambiguity or the interpretation which keep on coming around this, when do you say that you have availed credit? When you have availed in your books, right, in your ITC GL, or when it is actually going in the GSTN portal when the 3B is getting filed, which is in the electronic credit ledger. How the department is going to see this? If it is electronic credit ledger, then it will actually get reflected only when the 3B is filed, which means that November return, if it is falling due on 20th December, is it availed on 20th December or November? So this, while the view should be November credit should be allowed even if it is reflected in December 20th, but this may come up as a question. Now, just taking this a step further, what can also happen, earlier it was linked to the due date of October return. So even if the assessee has not filed, then the date ends on 20th October. Now, if it is November, and if one does not file the November return even by 20th December, because he is not able to finalize the credit and extend it to January, will it also mean January? So this is something which has to be seen. Representations have been made on this, and possibly some clarification we are expecting around this. The second is basically important change which has happened is under section 50 subsection 3, which is the provision for interest. Now, again, there was a interesting dispute which was happening. There was a Tamil Nadu, Telangana High Court divergent views. Meda engineering was against assessee, which is in case of Telangana High Court, April 2019. There was a GST Council meeting, 31st GST Council, which held in December 2018. They mentioned that the levy should arise only if there is a misutilization. It cannot be on a both entry, which is on availment, because there is no prejudice to revenue, and which was also because the provision which stood under the Senvat law under Rule 14, following Indo-Swift and Belforge. Now, what is interesting, what has happened, that they have brought this provision in the statute, in the bill, although after a period of 2 years, but now possibly once this is enacted, the dispute may not be there, that even if the ITC has been availed but not utilized, then there is no liability. There was a under section 50, there were two different rate of interest, 18% on short payment of tax and 24% if there was a levy interest arising due to mismatch. What they have explained, that even 18% would be the rate for all cases. So if there is any claim of demand on account of irregular availment and utilization of ITC, the interest rate is going to be limited to 18% only. So this is basically which was there on the input tax credit side from a GST standpoint. Other than input tax credit, the changes which has been made, again the important ones which are there under the GST law. One, what they have mentioned, that earlier the GST registration could have been cancelled if the returns have not been filed for a consecutive period of 6 months. Now, what they are talking about, that they are going to notify this. Possibly, it may so happen that they may like to reduce this period or deal this separately for a quarterly filer as compared to a monthly filer. We have to see what is the period which is going to be prescribed, but this is a change which they have done. The second is they have sort of brought in a provision and which was recommended by the GST Council in the 45th meeting. What they're talking about, that if there is a balance in the tax ledger which is available, that can be transferred to a distinct person, basically to any other registration of the same PAN, and this amount would be fungible and can be transferred. And if they have an output liability, then they can actually use this additional payment in some other GSTN to offset their liability. But what is important, they are talking about only the balance which is there in the tax ledger. It is not the ITC balance. So for tax ledger, this fungibility is now would be there once this is enacted. Barring this, because of the time limit change which has happened of 30th November from September return, they have made also changes, and they have increased the time limit for issuance of a credit note. Under section 34, earlier the time limit was up to September return. Now this is also increased to November. The second change, if there is any rectification or omission which is there, which has to be done, then for those also, those instances also, they have increased the time limit up to up to 30th November. So this, I think, just in the interest of time, I think I'm just touching 6 o'clock, so I'm mindful of time. So these are the important changes which I thought I'll highlight, basically, which is there from a customs and GST standpoint. So over to Mr.
Friends, there was marathon discussion and deliberation on the finance bill, both indirect taxes and indirect taxes. Thank you, Mr. Jaiswal. Thank you, Mr. Rakesh Gupta. Now I'll request Sandeep to express his views and also deliver vote of thanks to the guest and the members present.
So thank you, sir, for giving the opportunity. According to me, it is a budget where we advocates are getting a lot of opportunity in the days to come. Definitely, Abhishek will also agree with me. 16.4, Abhishek explained very well that the date has been extended to November, but for the up to 30th of November. Whether we need to see whether it is the filing of the November return or the clarification needs to come. But according to me, what little I have experienced, that it should be the return filing for the period of November. As regards to return this registration cancellation, reducing it will be a draconian provision. There are many small GST payers who do not get the money and they are unable to pay their taxes, especially the works contractor. So for them, it will be quite tough. Now let us see, everything will be explained in the time to come. I'll be giving the vote of thanks as well as because I've been entrusted to do that. Dr. Gupta, Sri Jaiswal, Sri Saraugi, Sri Suranaji, members of the chamber, guests and friends. Today's symposium has enlightened all of us about the various important aspects of Central Budget 22-23 presented by Srimati Nirmala Sitharaman, Honorable Minister of State, Minister of Finance yesterday. Our respectable speaker have very lucidly explained the impact of the possible implications that the announcement made in the budget this year are likely to have on the Indian economy. In this regard, I would like to thank Dr. Rakesh Gupta, ex-member Income Tax Appellate Tribunal, and Sri Abhishek Jaiswal, Associate Partner, Ernst & Young LLP, for sparing some of their valuable time to address this symposium. Friends, the Central Budget 22-23 is being hailed as being futuristic, with a lot of stress put on digital payment, electronic vehicle, improved infrastructure, startup and education. I'm confident at the end of the day and end of the today's symposium, our learned speaker today, with their thoughts, with their forward views and critical analysis, have enabled us to clear these ambiguities to a great extent. I thank the distinguished guests and the member of the chambers for making it convenient to attend this symposium on the Union Budget Proposal 22-23 and for participating in the discussion. With this word, I request you all to join me in carrying a hearty vote of thanks to the learned speaker with appreciative acclamation. Thank you. Thank you all.
Thank you. Deeply thank you. Thank you, Jaiswal.
Thank you.
Thank you, Abhishek. I'll call you later on.
Yeah, sure. Thank you, everyone.
Thank you. Thank you.